Welcome again. This is Robert Schein, Managing Director, Partner at Blanke, Schein Wealth Management. Today is Thursday, September 21st of 2023. We're talking about the three topics that are moving markets. We're paying attention to, so you should be too. So let's get right to it, and thanks for watching. So right out of the gate, no surprises. We anticipated the Federal Reserve would not increase rates, and that's exactly what played out. The Fed remains unchanged, but gave us a lot to think about and for markets to digest moving forward. They're still committed to a soft landing. That's our primary objective, is what was discussed yesterday. But yields and bond yields are on the rise. And actually the 10-year and the 30-year, we're going to show you, are breaking out to the upside. So we'll discuss the impact of that. But the Federal Reserve remains interest rates, kept interest rates at basically 5.25%, 5.5% range. And they're meeting, and it was unanimous, so there's no dissent. And they basically talked about the same messaging as previous messages, which is data dependent, higher for longer, and really trying to anchor that 2% inflation target is really the ultimate take-home point. And it was interesting, if you look at the term soft landing, the number of news articles that have mentioned that term has been off the charts here. And that's basically the theme. The question is, here's, over almost 1,200 articles, all over, and every publication is using the term soft landing. The reason why I bring that up is, if you look at previous times when soft landing was out there, from 2000 to 2007, 2008, when the Federal Reserve raised rates, what was preceded by that was a recession. Those gray bars right here. Let's go right here. These are recessions. This is a recession. And what happened? The soft landing conversation. So do we have a recession right here? That remains to be seen. But we will see how that plays out. But if history is a guide, we want to pay attention to that as well. The Fed funds nominal rate versus the real rate. Essentially, the nominal rate is our inflation rate. Real rate is ex-inflation. But ultimately, the 2% number is where they want to bring this right down. That's where their goal is. That's what they said and mentioned several different times throughout the press conference. Now, what's interesting about the most recent FOMC meeting was that they get together and they do what's called a dot plot, and they update and revise their economic outlook for the economy, and ultimately what their future holds as it relates to future interest rates. Rises or falls, and or declines, if you will, or cuts, if you will, and what their forecast ultimately is. And that just shows that going into 2024, 2025, we could be at the peak of the interest rate cycle. Another way to look at it is, this is another look back in time, going back to 2000, where we had plateaus for 8 months. The Federal Reserve, the upper limit of a policy range. So right now we're right here. We believe, markets believe, Federal Reserve kind of believes that they're at the upper end of tightening, meaning they're going to stop. Right now they're paused. They could go one or two more, but ultimately look at all the work that the Federal Reserve has done, as it's done in years past. Now, what does that mean if we go back to 2000 right here? Ultimately, it rolls over, and it rolls over very, very quickly. Why would that be, Rob? Well, it's because you're going to hit a recession. So we have to be very careful. Does a soft landing turn into a recession, as we showed you in previous slides? So what do we do here? When the market, or when rates are this high, are there opportunities, or are there things to be thinking about and positioning? Now, we're fully taking advantage of that for our clients at Blanke, Schein Wealth Management. In fact, the 10-year Treasury right now is breaking out to a new high. I've talked about this in length, that the 4.34 was your support on the 10-year Treasury. Now we're at 4.36, so we've broken the support, and now we're breaking up to the upside. Same on the 30-year. Ultimately, what we're seeing is this could be one last push higher of Treasury yields. We knew that would happen if we broke and closed above the 343 or the 434 level, which we did. So we checked that box. What that means is that's now the new floor, and now we can see yields on the 10-year go higher. So how do we handle that, or what do we do, or what do we position? You're going to lock in duration. You're going to go longer term in terms of rates, because ultimately, if we lock in rates when the Federal Reserve's now sort of toward the end of their cycle. We could see on the downside, you're locking in a higher rate. And then as interest rates come down, the bond prices go up. So there's tremendous opportunity in the fixed income market. We're doing that for our clients already. We're extending the duration on treasuries as they come due. We have tons of treasuries coming due for our clients. We anticipated something like this, and we were hopeful that the setup would play right into the hands of sort of our portfolio management, and it's actually doing just that for us. We're excited about that. For our clients in the U.S. housing, it's been trying to bottom, but higher rates matter, and we're seeing that mortgage applications are coming down. Ultimately, we can see obviously refinancing and everything's just impacted. Home prices are now being impacted, and the National Association of Home Builders Index is now at a inflection point earlier this week. That's something to be taking a look at and keep an eye on the home building market because it's a key component to the U.S. economy. Again, soft landing, if you will. And I'm going to bring this back up. If you didn't have an opportunity, please watch the sort of opportunities that we see in the market and how it's going to set up for the month of September and October. This is my interview with Frank Holland on CNBC earlier this week. And that's our update for today. Again, it's the longer duration. Take advantage of the next month and a half as we're seeing treasuries push higher, yields higher, lock that in, go extend it down the yield curve, lock that in, and then as yields come down, when interest rates are done and the Federal Reserve wants to bring them down, your bond prices, the value of your bonds are going to go up in value. So that's that inverse relationship we've always talked about. So that's it. Thank you for watching today. Again, remember to like and subscribe and share this to friends and family. Have a great day.